Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, everyday language. I'm your host, and in today's lesson, we're exploring an expert advisor called Baseline Deviation Fade. This is a mean reversion approach that watches how far price stretches away from a moving average baseline, and then looks for it to snap back toward the middle. Along the way, you'll learn how it combines an exponential moving average, the average true range, and the relative strength index into one disciplined set of rules. Remember, this video is educational information only and never financial advice. Let's get started. So what exactly does Baseline Deviation Fade do? At its heart, this expert advisor is a regime-filtered mean reversion strategy. The core idea is simple to describe. Markets often push price too far, too fast, away from a central average, and then price tends to drift back toward that average. This strategy tries to identify those overextended moments in an objective, rule-based way, and then position for the drift back toward the middle. The baseline itself is an exponential moving average, set to a default period of 50. Think of it as the strategy's idea of fair value. To measure how far is far, the strategy uses the average true range, a common gauge of recent volatility. By dividing the distance from the baseline by the average true range, the strategy expresses stretch in volatility units rather than raw pips, so it adapts automatically whether the market is calm or busy. On top of that, it reads the relative strength index, a momentum oscillator, to confirm that price has reached an extreme. It also checks the shape of the most recently closed candle, and it measures the slope of the baseline to judge whether the market is ranging or trending strongly. This is a symmetric strategy, meaning it treats long and short opportunities with mirror image rules. It works on a single time frame and acts only on fully closed bars, which avoids the noise of intrabar flicker. Because it is mean reversion, it is generally more suited to ranging or balanced conditions than to powerful one-way trends, and it includes a filter designed to step aside during those strong trends. Who is this style suited for in an educational sense? It tends to appeal to traders who are curious about counter-trend or fade logic and who appreciate clearly defined, objective entry and exit conditions. As always, trading carries real risk, and losses are a normal part of any strategy. Let's walk through the exact logic, step by step. The strategy evaluates its rules only when a new bar has fully closed, using the values from that just closed bar. This keeps every decision fixed and repeatable. First, the strategy calculates four things from the recent history: the exponential moving average baseline, the average true range, the relative strength index, and the slope of the baseline compared with the previous bar. Before looking for any new trade, it checks whether a position is already open. If one is, it manages that position instead of opening another. The management rule is elegant. For a long position, once the closing price climbs back to or above the baseline, the reversion idea has done its job, and the strategy closes the trade. For a short position, once price falls back to or below the baseline, it closes as well. The strategy holds only one position at a time and never stacks multiple fades. If no position is open, the strategy applies its regime gate. It measures the baseline slope in average true range units per bar. If that slope is steeper than the maximum allowed, with a default of 0.4, the market is considered to be trending too strongly, and the strategy simply stands aside. Mean reversion tends to struggle in strong trends, so these bars are skipped on purpose. When the market is calm enough, the strategy looks for a long setup using three conditions that must all agree. 1. The closing price sits at least two average true ranges below the baseline, the default deviation multiple. 2. The relative strength index is below its oversold threshold of 30. And 3. That same candle closed higher than it opened, showing an early sign of turning back up. A short setup is the mirror image, price stretched at least two average true ranges above the baseline, the relative strength index above 70, and a candle that closed lower than it opened. When a long setup appears, the strategy signals a buy at the ask price. It places a stop loss 1.5 average true ranges below entry, and a take profit 2.5 average true ranges above. A short setup mirrors this, with the stop loss above entry and the take profit below. That structure gives a reward to risk shape of roughly 1.67 to 1 on each trade, before the early baseline exit is considered. Every level scales with volatility, so the strategy breathes with the market. Now let's look at the actual MetaTrader 5 code driving these decisions. At the top are the input parameters you can adjust. EMA period sets the baseline length, defaulting to 50. ATR period and RSI period control the volatility and momentum readings. Deviation ATR multiple is the stretch threshold, defaulting to 2 average true ranges. RSI threshold is the oversold level of 30, and the overbought level is simply 100 minus that. SlopeAtrMax is the regime filter. SLATR multiple and TPATR multiple size the stop loss and take profit, and lots sets the order volume. Look at the long block. The Boolean called long setup is true only when all three parts agree. Deviation ATR is less than or equal to the negative deviation multiple, meaning price is stretched below the baseline. The relative strength index is under the threshold, and the signal candle's close is greater than its open. When that is true, the code reads the ask price, computes a stop loss below it and a take profit above it, each scaled by the average true range, and calls trade.buy. The short block mirrors it exactly. Short setup is true when deviation ATR is greater than or equal to the positive deviation multiple. The relative strength index is above the overbought level, and the candle closed below its open. The code then reads the bid price, sets a stop loss above and a take profit below, and calls trade.sell. Notice how both sides share the same volatility-based sizing, keeping the logic balanced and symmetric. Let's bring the whole strategy to life on a chart. On screen, you can see a series of candles, a blue line weaving through them, which is our exponential moving average baseline, and beneath the price a panel showing the relative strength index, with its oversold line at 30 and its overbought line at 70. Watch the opening candles. Price begins near the baseline, then starts sliding lower, candle after candle. Each new candle carves a fresh low, pulling price further and further beneath the blue baseline. This is the overextension the strategy is patient enough to wait for. As price drops, notice the relative strength index in the lower panel falling with it, dipping down through the oversold line at 30. At the lowest candle, price is now stretched at least 2 average true ranges below the baseline, and momentum is deeply oversold. 2 of our 3 long conditions are lining up. Now comes the important moment. The next candle closes higher than it opened, a small bullish candle that hints the selling pressure is fading and buyers are stepping in. That completes the picture. Price is stretched below the baseline. The relative strength index is under 30, and the candle has turned back up. The strategy signals along, and you can see the buy entry marker appear on that candle. At the same instant, the strategy places a stop loss below, scaled to 1.5 average true ranges, and a take profit above, at 2.5 average true ranges. Follow what happens next. Price begins to recover, drifting back up toward the blue baseline exactly as the mean reversion idea anticipates. Candle by candle it climbs, and the relative strength index eases back toward the middle. Price reaches the take profit marker, and the trade is complete. Notice too that as price reclaims the baseline, the early exit rule would also have closed the position, whichever came first. Now the chart shifts to the mirror image. Price keeps pushing higher, and this time it overextends in the other direction, rising well above the baseline. The candles climb, each printing a higher high, and in the lower panel the relative strength index rises up through the overbought line at 70. Price is now stretched at least 2 average true ranges above the baseline, and momentum is overbought. Again, 2 conditions are in place. Then the confirming candle arrives. A candle closes lower than it opened, a bearish candle suggesting the buying push is running out of energy. That satisfies the third short condition. Price is stretched above the baseline, the relative strength index is above 70, and the candle has turned back down. The strategy signals a short, and the sell entry marker appears. The stop loss is placed above, and the take profit below, both scaled by the average true range in the same way as before. From there, price rolls over and begins its journey back down toward the baseline. Candle by candle it slides lower, the relative strength index cooling off, until price reaches the take profit marker on the short side. Both trades illustrate the same repeating rhythm. Wait for a genuine stretch away from fair value. Confirm it with momentum and a turning candle. Position for the return to the baseline, and let the volatility base stop and target define the risk. That reward-to-risk shape of roughly 1.67 to 1, combined with the four-condition filter and the trend gate, is what gives this strategy its disciplined character. That brings us to the end of our breakdown of the Baseline Deviation Fade Expert Advisor. Today we covered how it defines fair value with an exponential moving average, how it measures stretch using the average true range, and how it combines an oversold or overbought relative strength index reading, a turning candle, and a trend filter into four conditions that must all agree before it acts. We also walk through the code and a full chart example of both a long and a short trade. Remember, everything here is educational information only and not financial advice. Trading involves real risk, and losses do happen. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with a strategy you'd like us to explore next. You can learn more at www.overbought.live. Past performance does not guarantee future results. Trade responsibly.